Flipping houses, unique tax considerations. Flipping houses in the USA presents a unique set of tax considerations that can significantly impact profitability if not properly understood and managed. The primary tax distinction lies in whether the activity is classified by the IRS as a dealer, ordinary income, or an investor, capital gains. This classification is crucial because it dictates the tax rates applied to the profits, with ordinary income generally taxed at higher rates than long-term capital gains. Factors influencing this classification include the frequency of sales, the duration of ownership, the extent of improvements, and the intent behind the purchase. Understanding these nuances from the outset is vital for effective tax planning and maximizing returns on investment. One of the most significant tax implications for house flippers is the treatment of gains as ordinary income. If the IRS determines that the flipper is acting as a dealer, someone who buys and sells property as a business similar to a car dealership, then all profits from the sale of these properties are subject to ordinary income tax rates. These rates can be as high as 37% for the top federal bracket, not including state income taxes. This contrasts sharply with long-term capital gains rates, which are capped at 20% for high-income earners. The frequency and volume of flips are key indicators the IRS uses to make this determination, along with the nature of the improvements made. Conversely, if a property is held for more than 1 year and is considered an investment rather than inventory for sale, the profits may qualify for long-term capital gains treatment. This is a much more favorable tax scenario due to the lower tax rates. However, it's challenging for active flippers to meet the held for more than 1 year requirement, as the goal is often to buy, renovate, and sell quickly. Strategies to potentially qualify for capital gains treatment might involve holding properties for rental income for over a year before selling, or demonstrating a clear intent to invest rather than immediately resell. Another critical area is the deductibility of expenses. Flippers incur numerous expenses, including acquisition costs, renovation costs, holding costs, utilities, insurance, property taxes, and selling costs, real estate commissions, closing fees. These expenses can generally be deducted, reducing the taxable profit. However, it's important to properly categorize these expenses. Some expenses, like significant renovations that improve the property, must be capitalized and added to the basis of the property and then depreciated over time if the property is rented, or offset against the sale price when sold. Proper record-keeping is paramount to substantiate all deductions. The fix and flip model often involves significant interest expenses if financing is used. Interest paid on loans used to acquire and renovate properties is generally deductible. However, there are limitations, particularly for individuals and pass-through entities, on the amount of business interest expense that can be deducted in a given year. The Tax Cuts and Jobs Act of 2017 introduced a limitation that generally caps the deduction for business interest expense at 30% of adjusted taxable income. Any disallowed interest can often be carried forward to future years, but this can impact current year cash flow and tax liability. Self-employment tax is another consideration for active flippers. If the flipping activity is considered a trade or business and the flipper is operating as a sole proprietor or through a partnership, the net earnings are subject to self-employment taxes, Social Security, and Medicare, in addition to income tax, and this can add another 15.3% to the tax burden on earnings up to the Social Security wage base and 2.9% for Medicare on all earnings. Structuring the business as an S corporation can sometimes mitigate a portion of self-employment taxes, but this comes with its own set of complexities and compliance requirements. State and local taxes also play a significant role. Beyond federal income taxes, flippers must consider state income taxes, which vary widely by state, and potentially local transfer taxes, property taxes, and sales taxes on materials used in renovations. Some states have higher capital gains taxes or different definitions of dealer activity. It's crucial to understand the specific tax laws in the jurisdiction where the flipping activity occurs, as these can significantly impact the overall profitability and tax strategy. Ignoring state and local tax implications can lead to unexpected liabilities. Finally, proper entity structuring is a key tax planning strategy for house flippers. Operating as a sole proprietor offers simplicity but provides no liability protection and subjects all profits to self-employment tax. Forming an LLC or S corporation can offer liability protection and potential tax advantages, particularly with regard to self-employment taxes. Each entity type has different formation costs, compliance requirements, and tax implications. Consulting with a qualified tax professional is highly recommended to determine the most advantageous structure based on the scale of the flipping operation, risk tolerance, and individual financial situation. We welcome you to subscribe to our YouTube channel for more informative videos. Thank you.